For most traders, their trades are exciting. They watch charts, they check the profit and loss of their positions throughout the day on their phone. But for me, in this trade, I honestly forgot it existed. That wasn't until I got the alert that my limit order filled and I just pocketed a net profit of $383.41. Before I share the details of why and how I sell longer term put options, let me ask you, have you ever sold a LEAPS put option in your favorite stock or ETF? If so, which stock and ETFs do you like to do that in? And if not, what's preventing you from selling those longer term put options? I want to hear from you, so please hit the pause button and let me know down in the comment section below. Now let me share with you why and how I sell long-term put options against some of my favorite stocks. Here you see the daily chart of Adobe. It's ticker symbol ADBE. A very consistently growing company that I like very much. The problem with it is that it's always so expensive. Now I'm going to zoom in for you here. At the yellow arrow, that's the date I sold a longer term put option against Adobe. Let me give you a little background information here, because I want you to understand my thinking whenever I sell these longer term put options. So first, fundamentals. On the date I did this trade was December 26th. At that point, I sold the 6-month $340 put option. And notice on that day, Adobe was trading for about $100 more than that. It was trading for around $446 per share. So just a note, that option I sold was about 25% out of the money. Now recently, Adobe had come down in price by about 20%. For selling that put option, I received $480. Not a bad paycheck. The problem though is that at that point Adobe was trading for around $24 per share, which when you look at its history, it really wasn't a problem because over its history, it trades about a 33 P to E. The problem was, in my opinion, on that date, it was still kind of expensive. You see, it was trading for about a 24 P to E. Now for some traders, they might say, well, that's not expensive, that's actually cheap, because over Adobe's life, it normally trades at a 33 P to E. However, like Buffett, I prefer to have a nice margin of safety. So according to the market, it was trading at a discount compared to what it normally trades for, but according to Randy, I wanted to trade it at a lower price. And that's why I sold that 340 put option, which is represented down here with this white line. Although Adobe had recently declined about 20%, the put option I sold was another 24% below where it was trading at on the day I sold that put option. So it's already at a perceived discount based on what the market likes to pay for it, but I wanted it at an even bigger discount. Well, what happened? Because of some news the market didn't like, Adobe went down in price even more to right around my 340 strike price put option. So it was indeed challenged. How worried was I? Well, not that worried, because this, in my opinion, is a ridiculous deal. Remember, Adobe normally trades around a 33 P to E. Well, if I had to deal with Adobe or even buy it down here at 340 per share, I'd be getting it at an 18 P to E. Personally, I would love to own Adobe at that price, and I wouldn't mind owning a good bit of it. But unfortunately for this account, it's not really my goal to collect shares. That's another account which I'll show you in just a second. My goal in this account is just to sell options to generate consistent monthly income. So my put option was being challenged at $340 per share, but at a ridiculously good price in my opinion. So I wasn't worried about it. And before I forget, I just want to show you the actual trade that I did. Here you see on December 26th, I sold the ADBE June 20th 340 cash put option, and I got $4.80 per share, or $480 minus commission for selling this put option. And I sold that put option for several reasons. The first reason was fundamentals, as I mentioned earlier. I felt like if Adobe got down to that price range, I'd be dealing with a stock that was tremendously undervalued. So I feel very comfortable dealing with it at that price. Another reason was technicals. This was an area that previously has served as technical support for it multiple times. Indeed, it served as support for it again, as we see here. But that put option I sold, that nice little paycheck I got there, it only took me about 20 seconds to place the trade. Yes, I had previously done some research, but it was very easy money for me. And in my opinion, very safe money. Once I placed the trade, the plan was just to kick back, relax, and wait the approximate 6 months to see what happened. But when I do a trade like this, a longer term trade, I always like to place a limit order to close it out early if at all possible. And that's exactly what you see happen here on June 6th. So we were able to close the position out about 14 days early, and we received almost all of our potential profit. So I've shared all the details of this trade, but the question is, why? Why did I do it? And why do I think you should consider doing something similar? First and briefly, for those who don't know, what is a put option? When I sold somebody this put option, what was I doing? I was basically selling someone insurance. I was giving them the right to sell me Adobe at $340 per share. If Adobe was below that expiration, or any point before expiration, they had the right to sell me 100 shares of Adobe. So just remember that. When you sell a put option, you're selling someone the right to put shares or to sell you shares of a stock within a certain time frame and at a certain price. So why did I do this trade? Well, there were several reasons. First, I was already dealing with a potentially undervalued company based on the market's perspective. I then went over 20% below the current undervalued price and sold someone the right to sell me shares at an extreme discount. So in my opinion, I was placing a safe trade for easy money in a company I really liked at a price I'd love to own the stock at. And notice I also gave myself plenty of time to be wrong and still win. The position did go against me, as you see here. But because it was a longer option, it gave the position more time to go in my favor, which is exactly what happened. By selling a put option far out of the money, like I did here with Adobe, and in a stock that was already undervalued based on what the market liked to pay for it, I was setting myself up for a very safe trade that had a very high percentage possibility of winning. But actually, the trade I just shared with you in Adobe, that's not the trade that prompted my Patreon's question. It was actually a longer term put option I sold in FedEx. So let me show you another reason why I sold this put option in FedEx. I like to sell put options in stocks that have recently declined in price. As you see here in this bottom right chart, that's exactly what has happened to FedEx over the past several months. It's experienced a very sharp decline of around 30%. Now I believe at this point, FedEx is probably undervalued, but I wanted to sweeten the pot a little bit more, just like I did with Adobe, so I sold put options even farther out of the money. There's something else that triggered me to sell this put option. It wasn't just a stock that's been declining, it was a stock that's been declining but looks like it might be bottoming out. Now of course there are no guarantees, but notice here on this bottom left chart what's been going on with FedEx. I'm zooming out for you here. I'm going way back out in time, going back to November of last year. So we're looking at a chart here of about the past 7 months. And notice that during that time, FedEx has been in a very sharp decline. And this is the same chart on the bottom right, but it's the weekly chart. Notice every time the stock price gets close to that downward sloping resistance line, it finds resistance. But notice what's happened recently. We now all of a sudden appear to be trying to switch direction. We have a new higher low right in here compared to the higher low back in here. We're also trying to push through this downward sloping resistance line. If I zoom in here on this bottom left chart, this daily chart, notice it actually did close above that line and held for one day. Yesterday closed right at it, and today it's like we might not be holding it. So maybe this isn't going to go our way. But you know what? We're still okay. And let me show you why. The first reason I still feel okay with this position is that I believe FedEx is a little bit undervalued. Not tremendously undervalued, but about 10% undervalued based on the market generally pays for it over the long term. Now remember, it's currently trading for about $2.23 per share. And when I sell these long-term put options, I only want to sell them at prices I'd be very happy to own the stock at. So what put option strike price did I sell? With FedEx trading for about $2.23 per share and already 10% undervalued, I sold the January of next year 165 put option. That option expires in about 7 months. But keep in mind, although FedEx is already undervalued by about 10% in my opinion, I'm selling a put option that's $58 out of the money. How much did I get for that? Well, I got $4.45 per share, or $445 for this put option. If I have to deal with FedEx at $165 per share, I'm very happy to do that. And I'm very happy to get $445 to see if I have the ability to buy a great company at an extreme discount. In just a minute, I'm going to show you something else I do when a stock gets extremely discounted like Adobe. But just to recap, why did I sell this longer term put option against FedEx? And why did I do it in Adobe? Remember, I sold them in what I consider very stable, consistently profitable companies. These companies were already trading at a discount, and I sold a put option, or I sold someone insurance at a stock price that was a lot lower than even its existing discount. And I got nice premium for selling them that insurance. And if things went bad, I would have been very happy to own 100 shares of Adobe at $340 per share. Or if things go bad with FedEx, at $165 per share. I think I'd be getting a better than Buffett deal on those shares. So in my opinion, it's a very safe trade. And in addition to that, the sweet kicker is that I got nice money up front for selling this put option. But there's something else I did that sweetened the pot when Adobe came down in price. Let me show you what that was. In addition to sharing all my stock and option trades in my large and smaller, mainly option trading account, I also share an account with my patrons where I buy companies I believe are either undervalued or companies that have the potential to grow rapidly. Here you see a couple trades I've done in Adobe over the past several months. When Adobe came way down in price and challenged that $340 put option I sold, I used that cash that I received by selling that longer term put option to buy a share of Adobe. As you see here, I paid $344.28 for that share. And notice what's happened since then. In just about 2 months, it's gone up almost 20%. So I basically got this share for free, and this share is up 20% to date. Not a bad return for a very stable company that consistently grows over time. But the dessert to me was that I basically got this share for free. I got it by selling a far out of the money put option that had a longer expiration day at a very discounted price. Selling put options in companies that are already discounted, that show signs of reversing downtrends, puts not only fundamental but also technical investors on your side and helps you to win trades. It doesn't guarantee you win every trade, but it does greatly improve the odds that you're going to win your trades. And what's the worst that can happen? Well, if you're trading in very stable, solid companies like I do, if you're assigned the stock because the put options are challenged, then you're buying a great company at an extreme discount. You're buying a great company at Buffett-like discounts. And that is very hard to do. But by using this strategy, you not only get a chance to do it, but you get paid to do it. But there are a couple other important tips you want to consider when you're selling these longer term put options. First of all, you must do them in strong companies. Companies have a history of being profitable in not only good markets, but also bad markets. In my opinion, you don't want to do this on companies that maybe haven't turned a profit yet or still losing money just because there's some meme stock. You want to do them in proven companies. And then you want to be patient. In fact, sometimes it's good just to forget these trades exist. Now, some of you might be thinking, but Randy, the return on that put option is very low. It's under 10%. And if you're using a cash account, then I agree with you. Now, personally, I use a portfolio margin account. So my required margin is very low. And I get interest on all the unused cash in that account. So I'm still collecting interest on all the other money I have sitting in that account, waiting to be deployed if I'm able to buy that stock at an extreme discount. And right now, the interest, it's really kind of adding up. It's around 4 to 4.5%. So if I get 4 to 4.5% interest on my money, then I get about a 4, 5, 6, even 10% return by selling these far out of the money put options on already undervalued companies. Well, I'm very happy with that because it also gives me a shot at buying a great company at an extreme discount. So I might sum up this strategy of selling longer term or LEAPS put options against my favorite companies this way. It's a boring strategy, but in my opinion, it's brilliant. You don't have to worry about checking your phone every second of every day. You don't have to panic if things go against you. You just collect consistent monthly cash flow while you wait for the opportunity to buy your favorite companies at an extreme discount. So who is this strategy good for? Well, I kind of brainstormed on this for a few minutes, and this is who I came up with. And this doesn't cover everybody, but if you do fit one of these categories, you might want to consider this strategy. First, it'd be good for professionals who have some cash but are very busy. They don't want to watch the market every day. They want to place a trade maybe once or twice a year and just forget about it. But they want to have the opportunity to collect some nice premium while also potentially buying stocks at an extreme discount. It's also good, in my opinion, for retirees. They've worked hard their whole life, and now they want to enjoy life, but they want to have their money work for them, and they want a shot at buying some cheap, really good companies. Well, to me, it's a perfect fit for them also. And if you're tired of micromanaging trades, worrying about trades every minute of every day, well, this is a strategy also that I think you should consider. Then finally, one of my favorites, if you want to get paid to have a shot at buying your favorite companies at a ridiculously good price, then I think you should consider this strategy. If you'd like to get an alert whenever I buy stock or sell options, check out the benefits of becoming a patron down at the link in the description below. Abby Beagle, I love the name, I love the picture, who's a viewer here on YouTube, recently asked me a question about what stocks you should consider selling put options in. If you've ever wondered about the answer to that question, check out the video at the link above and the description below entitled The Best Stocks for the Will Strategy. Until next time, happy investing, and we'll see you again soon.